Hello, hello. Following the news about the US pretty much banning semiconductors companies from doing business with China, we're going to be taking a look at Intel as well. Now, I did make a video about Nvidia, I did make a video about AMD as well. You can watch both before or after watching this one. But now we're going to get a little bit of a look at Intel, a company that has been battered down, and it had pretty horrible earnings. We did make a video when it had its earnings report. It wasn't looking great. The company actually did much worse than most people would expect. Now the thing is, after a company has been destroyed so much and it has had a pretty steep downturn, only good things could be happening to it, right? I mean, not necessarily, but the thing is, when you're looking at companies that are thriving, it's gonna be much, much more difficult for them to keep on thriving. However, when you're looking at companies that have been potentially, kinda battered down a little bit, they had some bad earnings quarters, then you may be looking at a more bright future for an investor, especially if we're looking at a company that is overall doing very well and is projected to continue doing well. Now, there are some things, of course, that have been, pretty annoying and potentially pretty ominous for Intel. But again, the company, in terms of its financials, it's pretty solid here, and it may be worth a little bit of a risk. Now, first things first, to start off the video, I always like to take a little bit of a look at the stock news module here in our tool. And remember that you can get access to our tool by becoming a Patreon by finding a link in the description box below this video if you're interested. But you should see, and you will see here, that AMD continues to encroach on Intel's market share. So AMD is the winner basically lately. It has massively increased its revenue, and it's doing better and better, and it's getting a quite significant market share from Intel. Now, Intel is a much, much bigger company, of course, doing a lot more in revenue here. But if you take a look at its financial statement, you will see here in the income statement, for example, that revenue has been slowing. And again, its most recent quarter was actually even worse than you would expect. And so we're projecting that revenue could actually go down, for example, the next year or so. So things are looking a little bit dire here, at least for the time being. And Intel may not continue to be the behemoth that it used to be. However, again, as you are dropping in performance and as your stock is going down, your investors, and generally speaking, the Wall Street expects less of you. And so this could actually propel the stock price upwards just because there are less expectations and they are easier to achieve. Now, if we take a look at the metrics here for the company, you will see that the PE ratio is sitting at 6.8, which is, of course, super low here, much, much lower than AMD and also Nvidia. And this is one of the things that I absolutely love, because I really, really like buying stocks when they are cheap, and especially when they are good companies. Now, yes, there are headwinds for Intel. We did talk about it, and I have pretty much extensively analyzed it in previous videos. But again, overall, you will see that they are doing well. Now, free cash flow is a little bit worse than it used to be, but remember, the company is actually spending a ton in capital expenditures, and this is why the free cash flow is down. So this is sort of like expected, actually very expected. The company has been buying back shares as well, and again, you cannot really be too concerned about the free cash flow metrics here, because they are artificially lower, and so the price to free cash flow here is higher because of the free cash flow being lower. I will tell you a little bit more about it a little bit later when we take a look at the financial statements. But you will see here that the margins are pretty solid over here and continue being fairly solid, with a return on equity being nice as well. The thing that I'm not a big fan of in terms of Intel here is their dividends. Now, if you know me, you know that I'm not a big fan of dividend-paying companies. And you will see here that the company is paying quite some dividends. You will see here in our dividends tab, which extensively analyzes the dividends of the company, that it keeps increasing its dividends, and pretty much hasn't had the year in which the dividends have decreased, which is nice for investors who are looking for income. Now, the current dividend yield effective, as we call it, is 4.57% based on the stock price. And when the market opens, this is going to be a little bit higher because the stock price is going lower. And The thing here and the problem with dividends is has multiple reasons why it's a problem. First of all, it actually extracts free cash flow from the company. So money that the company could be using to grow themselves, now they have to pay back to investors. And it may feel sweet getting that sweet money back to your account, but this actually hinders the progress of a company, and especially a company that seems to be losing market share here. So they would require the extra funding. I mean, it's beneficial to keep that funding, yet they have to be paying investors. And the other problem about this is the fact that if the company actually gets it's going to be a negative effect. If the company actually gets a higher payout ratio in terms of its free cash flow, for example. Now again, we'll talk about this. This is a little bit artificially high here. It's manageable, but as it keeps increasing, and if the company actually has less net income and actually less free cash flow, then you may be looking at higher payout ratios, and eventually it may be difficult for the company to pay back the dividend to shareholders, and they may have to cut it down, which would deeply affect the company's operations and the company's stock price, of course. Now, this doesn't seem to be about to happen. I mean, it will probably take many years for this to ever be an issue, really. But with a slowdown in what we saw for Intel, some potential thoughts are creeping in here, and you may be a little bit stressed about this one. But let's examine the finer details here in terms of the financial statements. And the income statement will tell you of a company that keeps increasing its revenue. And again, we're looking at like 80 billion here. A company like AMD is doing like 20 billion or something of that sort. But in terms of the net income, is like 3 or something. And you'll see here that Intel is sitting at 20. So it's much bigger here. It does increase their net income, but you will see a little bit of a slump here, if not going down, frankly, as you'll see. So yeah, things are a little bit steady and actually going a little bit worse for Intel in terms of what kind of net income they are generating here, meaning that they are incurring more expenses in order to get to this revenue. In terms of the balance sheet over here, the company has been buying back stock, as we saw, yet their total equity still increases very nicely over here. And this one is a company that doesn't really have additional paid-in capital here. It's basically buying back shares. And as you'll see, the total liabilities of the company is sitting at 73 billion. And if we take a look at the cash flow statement, you will see that the cash flow is 9 right now. But again, we'll talk about why that's the case, because previously it used to be 21, pointing to a company that is fairly solvent here, with like 70 billion in terms of total liabilities. 20 in terms of free cash flow is more than enough. You can very easily service your debt. But why 9 here? If you take a look at our net income, it's about the same from last year, yet the operating cash flow is much reduced compared to last year. And this is the first thing that you see here, the fact that we are having less in terms of the operating cash flow. And you can kind of see that this involves a change in working capital here. Working capital being the current assets minus the current liabilities of the company. And where this is negative, it means that the company spends some money over here, and that could be, for example, to buy something. And so this is some sort of a current liability, for instance, that was added. So this, or actually, it's probably a current asset that was added, and some money was spent towards that. So this could be the reason for this one. Buying, for example, a long-term asset and paying with current money, a current asset, would decrease the working capital. In terms of investing, you will see here that the company is doing its usual things, some purchasing of investments that you'll see usually every year for the company, and capital expenditures. Again, what I talked about earlier, you will see the massive increase in terms of capital expenditures, especially last year. We do know that the company is investing in themselves quite a ton, so we do expect these kinds of capital expenditures here. But the result of these capital expenditures is the fact that the company's free cash flow goes down to 10 billion over here. Now, that doesn't mean a lot. It could happen for a year or 2 or maybe 3, depending on what the company has planned. But the thing is, it is a management decision trying to propel the company upwards. So I don't have a problem at all with this one. I like the companies that are actually investing in themselves. Okay, now the most important question: how much is the stock worth, and how much is the company worth, and how much should we be paying for it? And the way to decide what to pay here is using our model. And you will see that the revenue growth of the company has been sitting at a measly 6%, and it could be doing worse. So I'm gonna go a little bit sort of like conservative, very conservative here. I'm gonna say that the company will do 1, 2, and 3% in terms of the revenue growth for the next 5 years. And the net income margins that they are going to be generating based on my projections here, they used to be at around 25%, 25, 27 over here. I'm gonna go a little bit in between, so I'm gonna go 24, 25, and 26 here. And in terms of the free cash flow margins, again, 80 to 100 makes a ton of sense. 80, 90, and 100, and 13% for the annual return. We hit calculate, and what are we getting? It's all green over here, and comfortably green. If we go 0% here in all our revenue growth, like no growth at all for the company, we are still in the green. What if we decrease our margins? Let's just say that the company generates, let's say 15%, and 17 and 19% over here. What's happening then? So even then, we're almost green in this one as well, very, very close. Actually, we are green in this one probably when the market opens, because we are down pre-market. So this is probably going to be green as well. At a 0% revenue growth, 15% net income margin, which is very low for the company. Have they actually ever done that? They have done in 2017. That's the last year. And 80% of free cash flow margin compared to the net income, which is basically 15% of a free cash flow margin here. Actually, no, it's 80% of 15%, so it would be like maybe about, I don't know, like 13%, 13.5, something of that sort. It's a percentage of this net income margin, pretty much. And yeah, we're still in the green and comfortably again. And so, based on the comments that I've seen, I do like, of course, I would love to hold both like Nvidia and AMD. However, with the case of Intel, it's also a very, very cheap company, and yeah, there is the trouble that the company has been doing badly lately, but even, it's so cheap right now that even at a 0% revenue growth, this is still a screaming buy. And if it continues going down even more, this becomes even cheaper, and I would more than likely be looking to enter. In fact, I would have probably already entered this stock. The thing that I really, really disliked was the dividends. I'm a massive denier of dividends. I don't like them at all, and so I tend to avoid them if I can. And sometimes I do have some companies that are paying dividends, the very good ones and the very solvent ones, just to to have a little bit of a diversity in my portfolio. But overall, I'm not a big fan. I'm not a huge fan of this kind of companies. They tend to be sort of like not growing much. They tend to be sort of like stagnant for a while, almost like dead money, I would say, for a lot of these companies. But in the case of Intel, I would definitely be looking at getting it, because it's been going down a lot, and there's a ton of value in this company. It's very, very cheap, so I could definitely see myself adding some, even if there is some risk here. But do tell me what you think about Intel, guys. Remember, you can leave a comment and let me know. Let the others know as well. Very, very interesting discussion right now around semiconductors. I'd love to hear your opinion. And remember to leave a like and subscribe, and I'll see you in the next one. Remember to take a look at the video that I made earlier about Nvidia as well, so that you can have a little bit of a more rounded opinion about what has happened today in the markets regarding semiconductors. See you soon. Bye-bye.